Most super investors still hold the usual suspects. We have Microsoft at number 1, Google at number 2, but here's the thing, that really doesn't tell us anything new. What's far more interesting, in fact, is to understand what have the top investors been buying in the most recent quarter, and that is where the real value may be hiding. Now, I'm sure you're aware every single quarter they're legally required to disclose their latest portfolio moves through a document called a 13F filing, and that is exactly what gives us a window into what they've been adding. Think Warren Buffett, as we can see here, his portfolio movements in the latest quarter, and the same to be said for the likes of Bill Ackman and many other popular super investors. And what's very exciting is that some of these new picks aren't particularly what you'd expect. And in this video, we're going to break down the top 10 stocks that super investors just bought in quarter 1, and we're also going to give you our own perspective on the valuation, whether we believe they are a good buy at this moment in time. Now, we're kicking off with the semiconductor TSM, one of the most bought stocks by super investors in Q1, and this is a company that is up 28% over the last year. Year to date, in fact, it is down 2%, and over the last 10 years, it has massively outperformed the S&P, up 703%, whilst trading in the mid to upper end of the 52-week range. Both Wall Street and Quant do believe this is a strong buy, and we also notice a buy rating from Seeking Alpha, so very clear, analysts do still believe TSM is an addition to the portfolio. And when we take a look at the forward P, which sits at 20.6, that is below the 5-year average of 22. That is in essence what we would call a potential undervaluation signal, but worth noting the yield on offer at 1.69 isn't far off the 5-year average of 1.78, so this in turn actually a little bit contradictory and tells us the company could be reasonably valued. And also worth highlighting that we do use another model here, which is the blue tunnel, telling us the expected fair price, and always great to see it increase over the longer term. Not something we'll see with every company, and in fact that will be reflected in today's episode, but what's nice to note is that the company is trading towards the lower end of the blue tunnel, still a reasonable signal, but worth pointing out as well, over the last few weeks and months, this company was trading at a severe undervaluation, as there was disparity between the lower end and the historical trading price, something just to point out. But based on these metrics, TSM for the large part does look to be reasonably valued. But remember, we're not looking at any of those models in isolation. We are going to run it through our own valuation process shortly, and worth highlighting the growth of each of these companies, where TSM does get a B+. Year on year, very strong, up 40%. Forward looking, estimated 28, when we do in fact notice that is significantly above the sector in the mid-single digit, and also they're increasing their revenue at a faster rate than they have done over the last 5 years at 21 and 17% respectively, whilst also anticipated to grow their EPS 21% over the next 3 to 5 years, above the sector at 13, but also above their historicals at 19.1. So we have a company here, TSM, growing their revenue and expected EPS at a faster rate than their historical as well as the sector. And always great to see green right across the board when we take a look at the earnings. This means over the last 4 quarters they outperformed against analyst targets, 100% track record, and over the next 4 quarters they anticipate every single one to be growth to the earnings per share. And for those that like to look at the next full accounting period's expected forward P, well, for 2026 it currently sits at 18.2. Now, intrinsic price gets to $223, which is purely the average of the 3 models that you see on screen. Now, when we do our deeper dives, we do in fact run through the inputs and the outputs. Today we're looking at top 10 stocks super investors are buying, so we are going to get straight to it. 223, current price $190, and we always, before executing on a company, look for at least a minimum 10% MOS, where we execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for TSM, a buy at $201, then we keep on going till it's near the current trading price, and we see, as of today, we see a 15% MOS for TSM, with Wall Street themselves $220 price target over the next year, translating to 16% upside. Now, also factor in, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for TSM or any other company. And we'll also highlight, for those that do want a larger MOS, 20%, a buy at 178, 25 at 167, and for those who want 30%, 156. So in conclusion, TSM, one of the most bought stocks, 15% MOS, 16% upside. Also worth giving your own opinion if you do see this as a buy or you are adding in Q1. Thank you to today's sponsor, Snowball Analytic, and they're much more than just a portfolio tracker. They have a ton of useful features as well as a user interface that is extremely easy to consume. They highlight a lot of information. You can see the largest gainers for the day as well as the losers in your own portfolio. They highlight some of the recent and upcoming events, which include both earnings as well as when your company's dividends are being paid out. And for the dividend lovers amongst us, they also highlight the different ratings that each company holds in terms of their dividend safety, really pinpointing those that maybe you want to take a further look at. A few really cool features that we want to highlight, for example, comparing your portfolio against the S&P. For those who perhaps want a bit more inspiration, they also tell you when companies are expected to pay out their dividends, and one of our favorite is really giving an in-depth view for every single company. For example, if we take a look at Nvidia, one analysis here is purely just on the income statement, but it doesn't stop there. We can take a look at the quality of the company in terms of the balance sheet, the cash flow, as well as some very important financial metrics that we always like to look at before considering a company to be a buy. And the great thing is, right now they do have a 30% off discount as well as a free 14-day trial. So check them out, click on the link below and grab a very nice discount. We then move on to TXN, Texas Instruments, where we do in fact notice down 3% over the last year. Year to date, pretty much flat. Over the last 10 years, another outperform of the S&P, although to a smaller degree, up 240%. Trading around the midpoint of the 52-week range, and unlike what we just saw from Taiwan Semiconductors where every analyst was super bullish, we get the opposite with all three giving this a hold rating, not something super investors do agree on. And we can also highlight we get the opposite effect where the forward valuation sits well above the 5-year, 33 versus 25, an overvaluation signal, and we can see the yield not far off, so a reasonable one noted here. Finally, when we do take a look at the blue tunnel, not only is there large disparity between the upper end and where the value sits today, but pretty much for the majority over the last year, Texas Instruments has been trading at a severe overvaluation level. Growth not looking the greatest at a D+, year on year -5%, forward looking estimated 3. We can see the sector a lot better in the mid-single digit, but historically over the last 5 years they haven't really been growing their revenue at a very impressive rate, but they do anticipate EPS to grow at 13%, which is not only in line with the sector, but a lot better than the 5-year at 7.2. Earnings not looking too bad either. Over the next 4 quarters, every single one growth, with in fact a 75% track record. The most recent 3 quarters were all in fact beats, and if you look at 2026, they're trading at a forward valuation of 28.6. Now intrinsic price gets to $186, which is pretty much the same as what it is in the market today, meaning we believe this company is trading at its intrinsic value, no margin of safety, not trading at a premium either. But for those that want 10% MOS, well, a buy at 168. For those that want 15 at 158, at 20, $149, and at 25%, $140. Wall Street also in agreement. They see no upside over the next year, around $185, indicating -1%, but would be interested to see maybe this one, like super investors, you have been adding to the portfolio, or you're in total agreement in fact with the analysts that this one is a hold. Now before we continue, we just want to let you know we have released our latest free weekly article. We draw on every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of May. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that you can grab a recently released copy of 19 stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. We then move on to Eli Lilly, which in fact after the market close on Friday we can see was down nearly 7%. It's pretty much flat over the last year, year to date down around 2%, but over the last 10 years massive outperformance of the S&P, up 919%. trading towards the lower end of the 52-week range, where we get a double buy from Seeking Alpha as well as Wall Street, and we get quite a significant undervaluation signal with the forward P pretty much around the 30 level, given their 5-year average has sat just under 38, but you are also getting a yield which is much lower at 0.8% than the 5-year average of 1.24. And interesting to note, not only do we see in fact here disparity between where the company sits and the lower end, but it has been increasing in its intrinsic value quite sharply over the last year. And remember, this is the pattern you want to see from companies you're considering investing in. The stock price decreasing, but the actual intrinsic nature of the company going in the opposite direction in an upward trajectory. Their growth does look phenomenal at an A+, year on year 36%, forward looking 28%, sector sitting somewhere in the mid to upper end of the single digit, and we can see they're also growing much faster than their own 5-year at 14 to 12%. And we can see EPS also expected very rapid growth, 33%, well above the sector at 10, and also well above their historicals at 21.2. Over the next 4 quarters as well, double digit at a bare minimum in terms of growth to the earnings per share. However, they do have a 50% track record against analysts, with the most recent quarter being a 12-cent miss. And if you're looking to 2026, they're trading, again, if you believe they can hit those estimates, at a forward valuation of 25.5. And our intrinsic price gets to $691. It is derived solely from the DCF model, so we can in fact just give it a glimpse. Now, the average growth to the free cash flows has been 44% over the last 10. Moving forwards, we have gone for 35%, but again, that is fairly high, so do factor that in. Using that and the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to 691, indicating downside of 2%, but you can see not that far off the market price, meaning already baked into the numbers is growth rate of 35% moving forwards. So if you do really believe in the company and you expect a sizable upside, at 40%, that would come to 958, indicating 36%. If you believe these numbers are way too high, well, even at 30%, intrinsically 491, indicating downside of 31. Now, as typical, we will take the median rate, and at that 35% point, we're essentially saying no margin of safety. It is trading at a little bit of a premium for those that do want to see. At 10%, buy at 622, at 15, 588, and at 20, we see $553. 25% even lower, 519. Wall Street, though, very bullish, $990 price target in the next 12 months, upside of 40%. Give us your thoughts though, no margin of safety, 40% upside. Are you leaning more towards the point of view of super investors who ultimately in Q1 would have bought this at a higher price? We then move on to Dollar General, which is down 36% over the last year. Year to date though, very strong run, up 23%. Over the last 10 years though, it is up only 27%, massive underperformance of the S&P. All-time highs sitting around the back end of 2022 at $260, and we see it trading towards the lower end of the 52-week range with a double buy from Seeking Alpha and Wall Street, although note both of these are fairly weak, near the 3.5 that just turns this into the buy rating. But we do get a double undervaluation signal, forward P 16.7 below 19.6, and the yield on offer very high at 2.5, well above the 5-year that sits just under 1%. Although bear in mind we do get a speculative signal here, and in essence what we can see, it is trading below the bottom end. That would be an undervaluation signal, but it's also important to understand that this has been trading at least over the last year for the majority in that undervaluation point. Now their growth doesn't look great at an F. Year-on-year revenue 5%, forward-looking around 4%. That is slightly above the sector in the 2 to 3%, but over the last 5 years they have been growing their revenue at a much faster rate in the 8% region, and EPS is pretty much expected to be flat over the next 3 to 5 years when the sector and their own historicals sits at the 6 to 7% region. And over the next 4 quarters, only 2 of them expected to be growth, and they've missed 3 of the last 4 quarters. In fact, the most recent 3, 25% track record, trading on 2027 numbers at a forward valuation of 15.2, and our intrinsic price gets to $89, which does mean that we see, like Eli Lilly, the company trading at a bit of a premium, no margin of safety. At 10%, buy at $80, at 15% at $75, at 20, $71, and at 25% $67. Wall Street themselves also see no upside, in fact 1% downside, $93 price target into 2026. We then move on to Salesforce, which is up around 2% over the last year. Year to date, down double digit, negative 13. Over the last 10 though, this one outperforming the S&P, up 288, trading the midpoint of the 52-week range. Double buy from Seeking Alpha as well as Wall Street. We get quite a large undervaluation signal, forward P 26 below the 5-year of 31, and that's also reconfirmed when we take a look, although disparity is only getting smaller and smaller, so it may soon enter into reasonable signal, but also factor in that the expected price of the company has been decreasing, not typically a sign we do want from companies we want to invest in, and their growth does come in at a C, year-on-year revenue and forward-looking in the 8 to 9% region, marginally above the sector comparative in the 6 to 7, but we do also have to flag over the last 5 years they've been growing their revenue at a much faster rate, well into the double digit, but EPS is expected to grow fairly strongly, 18% above the sector at 13 and only marginally below their historicals at 20. Growth moving forward is looking fairly healthy as well. Every single quarter growth anticipated with a 75% track record and forward P on January 2027 numbers at 23.2. And our intrinsic value of $371 is derived from the DCF. So showing you today, this is using a growth rate of 12% on average over the last 10 years at 31%. This does then indicate 29% upside, and using the 12% rate, you are getting quite a sizable margin of safety, maybe the first time we have seen on the episode today so far. 25% a buy at 278, so right now we see this sitting somewhere between a 20 to 25% MOS. Wall Street themselves, 365 price target, upside of 27%. But we can also highlight that using a 10% growth rate moving forwards, being a bit more conservative, does still offer you a margin of safety. At 10% is pretty much where we see it at the lower growth rate. Upside still fixed. Wall Street see this 27%. The next stock super investors have been buying is Comcast Corporation, down 10% over the last year. Year to date, down 5%. Over the last 10, up only 23%. We can see all-time highs. You'd have to go nearly 4 years ago at around the $62 mark, trading towards the lower end of the 52-week range. A double buy from Seeking Alpha and Wall Street, although again fairly weak in terms of the rating. But we do see a double undervaluation signal, forward P of 8, that is quite below the 5-year of 11, as well as the yield nearly touching 4% when the 5-year rolling is at 2.7, and reconfirmed that undervaluation signal, although worth highlighting, very similar to Salesforce, expected price has been coming down, and one that has continuously, at least over the last year, been trading in that severe undervaluation element. Growth not looking good at all at a D-, year on year 1%, pretty much the same expected into the next 12 months. Sector as a whole not that much better at the 2 to 3% point, and the same to be said for their own 5-year average. EPS anticipated not looking great at all at 5%, considering both sector and their historicals sits between the 10 to 11% region, and over the next 4 quarters, only 2 of them is growth anticipated, and fairly marginally for quarter 3 at 2%, but they do have a 100% historical track record, with 2026 EPS sitting at 7.6, and our intrinsic value at $44, the average of this 4. Again, you can grab a copy of this model by clicking on the pinned comment below. Doesn't have to be for Comcast, any other company, but at $35 will give you a fairly sizable margin of safety, pretty much sitting at 20%, a yield that's not looking that bad near the 4% point. Wall Street see upside 17%, their own price target sitting at $41. Is this one that interests you at all? We then move on to DHR, which is down in fact 26% over the last year. Year to date, down 15%. Over the last 10 though, it has marginally outperformed the S&P, up 126%, trading towards the lower end of the 52-week range. A strong buy from Wall Street, a buy from Seeking Alpha with a hold from Quant. We get that undervaluation signal, the forward P of 25, not only well below the 5-year of 30, but also one of the lowest it has traded at over the last 5 years, with the yield of 0.65, again one of the highest on offer to shareholders over the last 5, with the average at 0.39, and that's reconfirmed when we take a look here. It is sitting just below that bottom end of the blue tunnel, so everything does point to this company being undervalued, but growth not looking great at a D-, barely an increase year on year, 3% expected over the next 12 months. Sector looking a lot better in the 7 to 8% region, as well as their own 5-year, where we do in fact get that double digit. In terms of EPS growth, expected around 8.5%, not far off in fact both historicals and the sector in the 10% region. They do however expect 3 of the next 4 quarters to be growth with a 75% track record. Nice to see most recent quarter a fairly sizable beat, and 2026 valuation on a forward P dropping to 22.9, and our intrinsic price of $230 will give you a margin of safety at 10% a buy at 207, at 15 196, at 20% not quite there yet, so we would say sitting somewhere between 15 to 20%. Wall Street themselves, $245 price target, 28% upside, maybe one of the more attractive options today based on the MOS and upside, but again, let us know below. We then move on to Microsoft, which was the number 1 stock that super investors added to their portfolio in the latest quarter, and by quite some distance. Over the last year, up 9%, year to date, up 8%, over the last 10, up 869%, massively outperforming the S&P, trading at the upper end of the 52-week range. We get a strong buy from Wall Street, a buy from Seek Alpha, with a hold from Quant, but not far from the 3.5 to flip this into a buy rating. But also worth highlighting, in just the last month, you could have bought this company near its 52-week lows, which perhaps was maybe where a lot of these super investors did see value, did see opportunity, and were loading up. We pretty much get a reasonable signal now with the forward PE in line with the 5-year average, although the yield on offer is slightly below the 5-year of 0.85, and we pretty much see this bang in the middle of the blue tunnel. That is a reasonable signal, something that we just saw confirmed earlier on. And the growth not looking promising at a C-, but both year on year and forward looking in the 14 to 15% region, above the sector median, which is in the mid-single digit, and we can see they're pretty much consistently growing at the same rate they have done over the last 5 years, with expected EPS around the 12.2%, marginally below both sector and their own 5-year historicals. Nice to see, and maybe expected for the company, green right across the board, trading on June 2026 numbers at a forward P of 30.1, and our intrinsic value at $488 derived from the DCF model does come for a growth rate of 16%. However, we will flag, if you do believe it should be lower at 14 in line with the 10-year, then right now the company does look to be overvalued with downside of 5%. Even in line with analyst expectations around the 16% point, there is upside, there is a margin of safety, but both of these are fairly trivial. You're not getting 10% just yet. It's sitting somewhere between 5 to 10% MOS. Wall Street themselves, with the strong buy rating, only see 13% upside. Their price target into 2026, $505, but perhaps maybe this is one you're in agreement and you were adding in Q1 of 2025. We then move on to Nvidia, where super investors were loading up, in fact probably towards the dip. As we can see over the last month, this one was in the region of below $100. Now year to date is pretty much flat. Over the last year, strong, up 43%. Over the last 10 years, massive outperformance of the S&P, up more than 25,000%. Trading at the upper end of the 52-week range, hasn't yet caught up to the 52-week high of $153, but we can see Wall Street strong buy, Seeking Alpha's buy, and a hold from Quant not far from that 3.5 buy. We do still, however, get a forward PE of 30.9, well below the 5-year average of 42.8, so this still looks to be severely undervalued solely based on this model. And we do in fact here get another undervaluation signal. Great to see the blue expected price increase and rapidly, but there's massive disparity still noted, so another one that we would say is severely undervalued. Growth also looking phenomenal at an A, year on year 114%, forward looking 60%, well above the sector in the mid-single digit, and also growing faster than their own 5-year, which also looks very strong at 68 and 41% respectively, and EPS anticipated to grow 35%, well above the sector at 13, and also above their own 5-year at 28. So Nvidia is growing much faster than their own 5-year in terms of revenue, as well as expected in EPS. And maybe no surprises now to see over the next 4 quarters, essentially in 2026, everyone is expected double-digit growth to the earnings per share, 100% historical track record, trading on January 2027 numbers at a forward valuation of 24, and our intrinsic price of $162 is derived using a growth rate of 20%. Bear in mind, over the last 5 years, they've grown at 153% year on year, over the last 10, 104. So on the 20%, you are in fact getting upside of 23%, but if we were to lower this down to 15, then the intrinsic price would be 115, indicating downside of 13%. So on the 20% moving forwards, you are getting a margin of safety, and as we keep on going, 10% by 146, at 15, 138, you're getting 20% around the $130 mark, not far off. With Wall Street themselves, price target 165, upside of 25%. Is Nvidia, in your views, one to buy, or perhaps one that you were adding sub $100? We then move on to another semiconductor that super investors were loading up on, ASML. Now down 19% over the last year, year to date up 8%, over the last 10 years, outperforming the S&P up 574, trading towards the lower end of the 52-week range. Double buy from Seeking Alpha as well as Wall Street. We get another undervaluation signal, 28.5 forward P below the 5-year of 34. Yield is pretty much in line though, so this would be argued as a reasonable signal. And we can in fact see here that undervaluation disparity, although that has been noted pretty much from the beginning of the year. Growth does come in at a C+, year on year 18%, forward looking at 9. Also worth factoring, semiconductors as a whole is a cyclical industry. Sector median though does sit lower in the mid-single digit, but we have to point out over the last 5 years they have been growing their revenue at a much faster rate, and in terms of EPS, expected 19% over the next 3 to 5 years, above the sector at 13, but slightly below their 5-year of 22.4, and we can see out of the next 4 quarters, 3 of them to be growth, 100% historical track record, trading on 2026 numbers at a forward valuation of 24.8, and our intrinsic value comes to just over $1,000, where we have used a growth rate of 14%, but we'll also flag using the lower rate at 12 still does show upside. Now in terms of a margin of safety, at 10% about 950, at 20 around 844, at 30% around 738, which is pretty much where we see the company now. Wall Street themselves, $943 price target, upside of 28%, so maybe one of the better looking options today, but as always, do let us know. We'll also highlight at the 12% growth rate, you are in fact still getting a margin of safety. At 10%, abide 828. At 20%, pretty much where we see this. So still looking strong if you are someone that does agree the low rate is more appropriate. And we'll go one step further for those that want to be even more conservative at the 10% growth rate. You are also still getting a margin of safety. At 10%, not quite there yet, at 721 is where it hit, but sitting somewhere between 5 to 10%, more towards the 10% region. And as we said, Wall Street very bullish, 28% upside, $943 price target. As always, let us know if you've also been adding any of these, not just in the more recent period, but also in Q1 where the super investors were loading up on the drops that we saw. And don't forget to sign up to the free weekly newsletter. We are dropping the next copy tomorrow morning. Grab those spreadsheets as well. Come and join us in the Patreon where we cover our weekly buys and sells. And as always, have a great day. We'll see you all on the next one.